My name is Wayne McDonald. I'm the Chief FX Market Strategist for Traders Way. An ECN where you could trade Forex, energy, metals, indices, binaries. Pretty much anything your heart desires. Not credit default swaps though. But more than enough for a healthy trader to be happy and satisfied and wealthy. A lot of traders may have been long dollar. They're long dollar because they feel the Fed's going to raise interest rates, which would create bullish dollar. I mean, I get it. The thing is, they're just wrong in the Fed stuff. And I think it might be because they get their analysis from CNBC and the Wall Street Journal, which is, I think, the worst part of this whole story. Like, how does one come up with the idea that the Fed's going to raise interest rates in April? How do you even get that? Because I look at the data, now there's nothing that suggests the Fed's going to raise interest rates. Not the median minutes, right? Not historic numbers, not inflationary numbers, not wage numbers, not confidence numbers, there's nothing. So how does one that's in charge of $1 billion fund come up with the opinion that the Fed was going to raise interest rates in April? I mean, how do you, like, give me one reason kind of thing. So but it's a great way to sell newspapers. So that, you know, that's why you got to be on the clue train. CNBC doesn't care about you. Bloomberg doesn't care about you. They're media. They're just reporting. And these are interesting topics. They are the topics to be concerned about. They are topics to talk about. When will the Fed raise interest rates? Well, do your analysis. And when they do normalize, at what rate are they going to normalize? And how are they going to do it? Now, I've already told you, I think what they're going to do is change the discount rate, but change the Fed funds rate. That's going to be the first clue. I've already told you this months ago, and we haven't even done that yet. Now, how does Wayne McDonald come up with that opinion? Well, let's do a quick Fed, quick Fed lesson. There's something called the Fed funds rate. What is the Fed funds rate? Let's call that interest rate. That's the Fed funds rate. Just for sake of argument, let's call it 0.25. What is the Fed funds rate? Don, be careful. The Commitment of Traders report is a Tuesday close. FOMC occurred on Wednesday. Even though you're reading it Friday. Just careful, okay? What is the Fed funds rate? Come on, guys. Fundamental Analysis 101. This is your first day in Fundies class, right? How about this? Type in a question mark if you want me to tell you. Good. Okay, Glenn says the cost of member banks to borrow funds overnight. From whom? There's a key distinction here that I'm drilling at. Okay. Wrong. Wrong. Wyatt got it, or Gakko's got it wrong too. The Fed funds rate is the lending rate that is used to borrow money overnight. All of that is correct. Okay, all of that's correct. Because what happens is you have required reserves that you must place into the Fed every single day. And it has to do with, you know, let's say you had 10% of your reserves, which are checking deposits now, right? So let's say there's $1 million in checking deposits that various have put in your bank, right? So now you got your checking deposits. Wow, we should probably let's get jiggy with this one. How do I add a whiteboard? I know we don't have much time. I've been talking for an hour already. Hang on, let's whiteboard this if it'll let me. Okay. Let's see if it'll allow me. I'm a bit slow in this one. All right, so let's try that. Oh, this is going to be really slow. I should probably just do this in Excel. All right, so you have over here. Wow, this is ridiculously slow. Yeah, hang on. We're not going to do the whiteboard. Desktop. Let's do the different way. Template. Oh, blank. All right, let's try it this way. All right, we need a balance sheet first and foremost. Okay, balance sheet. On the left, you have assets. On the right, you have liabilities. Okay, you have $1 million in deposits. Why is the cash in the drawers a liability to a bank? Yeah, because customers can withdraw it. You owe your customers the $1 million. How does a bank make money? It makes loans to businesses and people, right? So one way you can look at it is they're short on cash, but they're long-term long on their loans, right? They owe you on demand, right? They're basically paying you interest every single day, but they're making 30-year loans on mortgages. So they're short cash and they're long the loans, right? So anyways, now the Fed comes in and says you have to have reserves. You have required reserves, which is the RRR, the reserve requirement ratio, which is how much of the $1 million do you have to keep in? Okay? And that's what goes into the Fed. So currently in the United States of America, that's 10%. So you have to have 100K at the Fed. And you have excess reserves, which is, anything that you haven't loaned out. Because the other asset now, because now this is an asset because it's money parked at the Fed. Okay? Now, you also have some loans, right? Now, in a perfect world, if you're the bank manager now, think like a bank manager. How much in loans would you like to have in your portfolio? Up to 900K, right? But what happens now, well, let me ask you, if you make a 30-year loan like a mortgage, you have what happens if you have $900,000? Now you got your 900K, now you're in balance, that's why it's a balance sheet. You have 900K in loans. Okay, are your loans liquid? Do they convert in cash instantly? No. So what if someone comes in and says, I would like to withdraw $100,000 so I can buy Wayne's used Mercedes? All right, it's gone. So now you have 900,000 here. What's wrong? This drops to 90. You don't have enough money. But do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Do you want to dump some of your bonds? Or no, not bonds in this case, mortgages? Do you want to dump these? Heck no! Because you're paying your deposits, let's say what? Let's be generous, 1%. And you're lending it out now for 5%. And they're good loans because you did your due diligence. They're high credit people, right? Look at the money you're making. And you're not even doing it with your own cash. You get it? So you should have some excess reserves and stuff, right? That's why you shouldn't, being fully leveraged out here at 900K, you should probably, let's say, maybe as a bank manager, you say, we're not going to keep more than 8,000 on the books as loans, and we're going to keep 100,000 in excess reserves, because if someone makes a withdrawal, we can still cover the reserve requirement without having to sell some of our assets, because this is how we make our money. We don't want to sell assets. But let's say overnight there's a slight difference between how much you have to have parked at the Fed because of a withdrawal. And you're in good performing, profitable assets, but you're just kind of a little short on reserves. What do? You go to another bank. And you say, hey, JP Morgan, we're a little short on our reserves, right? We're a little short on our reserves. And so we need a short-term loan. Well, we adjust our loan portfolio. Maybe as loans come to due, you roll them over or whatever. But we're going to borrow for the short term to make sure we got enough at the Fed. Okay? Not that bad, right? So the Fed's fund rate is what JP Morgan charges you, the bank manager, for these overnight loans. And look, you're a profitable bank, you got lots of assets and everything. That's good. And it's overnight, and it's cash, so it's hardly anything, right? That's the Fed funds rate. Why do they call it the Fed's funds rate? Well, a lot of people get this confused because they think it's the Fed. The Fed's not doing it. Really, I mean, kind of. It's their job to manipulate that rate, but it's the rate that banks charge each other to cover the required funds that are supposed to be parked at the Fed. So to avoid all of this, that's why you just keep a little more. So in this case of the $1 million, you would keep maybe 100,000 at the Fed because that's the required reserves, RR, right? And your excess reserves, you might want to pad it a little bit and keep it, let's say, another 50 grand or 100 grand, just in case, to cover all this stuff, so you never get in the situation where it's 4:45 in the afternoon and you're calling JP Morgan for a loan. All right? So the Fed comes in a different situation. The Fed is called the lender of last resort. It's the whole purpose the Fed was created. In fact, the people that created the Fed would have hated and despised what the Fed has become, because they said, no, the Fed's going to manipulate the market, and it's going to do this, and it's going to do that, going to get involved. And we don't want it to regulate the economy. We just want it to be a lender of last resort. So if a healthy bank that's a little short on reserves needs help, and JP Morgan doesn't want to help them, and Bank of America doesn't want to help them, so on and so forth, well, then they can always go to the Fed. And the Fed will be there always. Okay? Always. And that was the only mandate the Fed had for a very long time. So study your history on this. It's interesting. All right, so let's move to the different part of the market now. So you can't borrow from the Fed funds rate. The Fed funds rate is an open market. It's the interbanking system for borrowing required reserves to the Fed. And it's bank to bank only. It's not to anybody else. and it's incredibly low right now. Now, historically, the Fed wants to deter banks from borrowing from them. Right? They want the open market to be the way to just go to another bank, borrow from them, borrow from them. But if it's 449, right, 459, and you're short on reserves, you can always call the Fed. We're here from you. So how do they entice banks to borrow from each other? Lend to each other, borrow from each other. How do they entice this? They charge more. Thank you, Kakos. They charge more. Okay? Okay? So you can come to the Fed, you're going to have to pay a premium. But as long as everything's good and you're healthy, they'll be there for you, and it's not a lot of money. But you're incentivized to, let's say it's 4:30 in the afternoon, you're like, man, I got a half an hour to get the cash that I need to park at the Fed, right? Just because a client came in, withdrew a bunch of money, you're like, wow, we're going to be short on our required reserves. It's 4:30, who do you call? You call JP Morgan, you call Bank of America, you start calling all your buddies, right? And if it's you got 1 minute to go and you haven't raised the money somehow for whatever reason, you call the Fed. Now, what happens if you call the Fed and you're like, Fed, I've called everybody on my list and no one's lending me money because actually we're not a healthy bank. We're actually in a bit of financial trouble. Some of our assets have gone bust. And this is what happens now when your loan side changes. Okay? Liabilities, assets, required reserves. So let's say you got 100K here. Okay, you got 100K here. You got 1 million. Right? So this is your RRR. This is your deposits. And then your loans, you have 900K. Okay? Now what? You're the bank manager, you come to work Monday morning and find out that a $200,000 loan has defaulted. Now forget about the house and stuff. What if it was a bond? Whatever. Default. Loans go down by 700K, right? But there's a loss. 200,000. All of a sudden, things aren't balancing out very well anymore. And so you also have bank capital over here, bank capital. And what if the bank only has 100,000 in bank capital? Well, the bank loses the 100,000, so now the bank is broke. It's got zero in its net worth, and it still owes $100,000. Now what do you do? Yeah, no bonus for the manager. Now he's jumping out of the window. So he calls the Fed funds rate guys, loan me money, and they're like, loan you money? You have negative equity. Right? You're like a Swiss franc trader at FXEM. Hey, you're negative 20 grand. But I had a stopping place. Yeah. Holy smokes. So no one wants to lend you money. Well, lend you money? You're broke. You're insolvent. So now you call the Fed and they're like, all right, we'll lend you, but now I'm going to charge you 1%. and you're now going to be audited for the rest of your life, and you're going to have to walk the shame, but whatever. So so that's why the Fed's there. They'll lend you to keep you alive if they have to, but then there's going to be a lot of scrutiny and so on and so forth. All right, so you got the Fed funds rate, that's the interbank rate, Fed funds rate, interbank. Okay, 0.25%. I'm getting there. I know you're getting upset with me. I know. Okay, then you have the rate that the Fed charges. Okay, and it's historically higher. Now the thing is, and I think these numbers are right. Wow. Let's do this again. Okay, so you can interbank and borrow at 0.25%. But if you need the Fed's there for you. The Fed's your friend. You can borrow it at 0.5%. Not a big deal, right? But historically, however, let's say when times are normal, let's say the Fed funds rate is 2.5%. Okay, that would be much more normal. The Fed funds rate would probably be 3.5%. Right? The prime rate is probably 4.5 or 5%. Let's just do it that way. And the rate on the 10-year T-note is probably 6%. Okay. That would be much more normal. So what do you notice here in these examples between a normal market and what we have now? Look at the spread between 2.5 and 3.5 versus a quarter, right? So the Fed, so let me draw this. When the Fed was lowering, they lower the Fed funds rate, and they do that by buying and selling in the open market. That manipulates the Fed funds rate. This rate, okay, is what they call the discount rate. Okay, and this is what I'm talking about now. This is the discount rate at the discount window. Okay? It's always higher than the Fed funds rate, but usually a lot more higher. So if I can change colors here, let's say the blue squiggly line is the Fed funds rate coming down. And let's say historically this is the discount rate. And let's say it's always, you know, a certain rate higher, let's say a full percentage point. And then after the Fed lowered interest rates to like 0, one of the things they did is suddenly they lowered the discount window, and it's been much closer than it usually has. Instead of the spread now being 1%, it's a lot less. Okay? So one of the things I've been talking about for the last year or so is that one of the signs the Fed should give before raising the Fed funds rate, right? That's when they talk about raising the Fed funds rate. Well, that's just the interbank rate. And they do that through the Federal Open Market Committee that do OMOs, Open Market Committee actions, right? They buy and sell bonds. And that manipulates the money supply, and that changes interest rates, blah, 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 blah. Nonetheless, when we were talking about interest rates and the Fed raising interest rates, they're talking about the Fed funds rate. So I'm thinking, shouldn't they at least normalize the Fed funds rate and get it back to a normal spread? So instead of, you know, and I think it's 50, I can be off, but I think it's 0.5%, and, you know, this is 0 to 25, so this would be 25, whatever. So let's say the spread here is 25 basis points, and let's say they, they'd rather it someday be a full percentage or 100 basis points, or maybe they want it to be 50 basis points instead of 25. But they should normalize. So the discount rate should go up first before the Fed fund rate, in my opinion, because they need to say the interbank system's healthy, the banks are lending each other money, everything's fine, the Fed doesn't need to be in crisis mode. We're not ready to raise a Fed funds rate because that's going to change things like the 10-year T-note. It's going to change things like the prime rate. It's going to change things like mortgage rates, right? Which could be prime plus a point, right? So your mortgage, let's say, would be 5.5 in a normal market, right? So on and so forth. So if they change the Fed funds rate, that's going to change these rates, and they're not ready to do that yet. But why do they need an artificially low discount rate if the interbanking system is working properly and functioning? Plus, if they raise the discount rate, if we're now talking about the balance sheet, how would that affect the economy? Well, historically, and let me clear this one more time. Let's see if you get this point. Historically, in your balance sheet, you had your deposits, you had your reserves, which are, let's say, required reserves, you had your excess reserves, and then you had loans. So let's say before the crisis, what did this look like? Right? Excess reserves were zero. And they took every penny they had and they made loans with it because they were in it for the money. Okay? Well, right now there's the reserves, so like as a percentage and stuff, reserves used to look like this. Okay, you had required reserves. How am I going to draw this now? Reserves, and it was at 10% or something, right? So you had your required reserves, and then excess reserves. I don't know if this makes sense, but I'm going to change the color here. That was fixed because that was required by law. But excess reserves went from basically zero until we hit the crisis, and then it went wham! And they still have an unbelievable amount of excess reserves because they're worried about the financial situation. They don't want. I mean, there was a big scare when the economic crisis hit, right? So now the banks are sitting on huge amounts of reserves and they're not making loans. Okay? So loans have gone down, excess reserves have gone up. That's not a healthy economy, right? The Fed wants them to lend that out. You understand? The Fed wants to lend that out. So what can they do now? They can raise the discount window if they want, or I suppose keep it low. See, if they keep it artificially low, let me think about this here. I suppose there's no reason to hang on to the excess reserves. Because they want them to lend. So if they raise they're going to want to hold. But I guess this is just a whole different topic, which obviously we're not going to have time today. There's too many reserves in the system. But nonetheless, you have the Fed funds rate, and you have the discount rate. The Fed funds rate is what banks charge each other in the interbanking system. The discount window is what the Fed, or the discount rate is what the Fed charges banks. If the banks borrow from the Fed, Normally, the spread is wide to entice traders, or banks to borrow from each other and not from the Fed. Right now, that spread is artificially and historically low. And I think the first step in normalization would be putting the discount rate, changing the discount rate higher, increasing the discount rate first before raising the Fed funds rate. Okay, that's the point that I'm trying to make here. The Fed should raise the discount rate before they raise the Fed funds rate, and that would give the market time to digest and prepare and understand. And right now there's just guessing and speculation, but I think that would hurt the least. All right. The only reason the Fed might not want to do it is there's too many excess reserves. So let's focus on the real estate economy. Are people borrowing money? And if so, where are the banks getting the money to lend to them? And if it's coming out of excess reserves, then that's a really good thing. So there's a quick lesson on the Fed funds rate and the discount rate. Do you have a better understanding now? I just chose to explain it from the point of view of a bank manager. So if you ever want to be a banker, I just taught you how to be a banker. It's interesting though, isn't it? It's just how banks work. You've just learned how to be a banker. Yeah, I find this stuff fascinating because you know what it does? If you understand this stuff, it translates into profitable trades. To me, it's fundamental analysis. It gets me into the trend. If you understand money, if you understand money flow, if you understand Fed policy and how it works and actually how they do it, and that you could track the money, where I could bust out a spreadsheet and say, this is what the Fed's doing, watch it. Yeah, I find that interesting versus some guy that just sits down and says, oh, I think the Fed's going to raise interest rates, and then is surprised when he's wrong. Like, really? Well, you just don't, it's just, there's a lack of knowledge. And the sad thing is that person with the lack of knowledge and no comprehension, unfortunately, is in charge of $1 billion hedge fund or mutual fund or whatever they do. They don't get it. I find it fascinating because it makes trading, dare I say, easy. Well, it makes it easier. So anyways, got to go. I know it was like a 90-minute session. I apologize for that. But I hope it was worth your time. I know your time is valuable. Peace on earth. May the pips be with you. May your profits be above average. And if you learned something or at least enjoyed the discussion, leave a comment if you're watching this on the video. Thumb it up, leave a comment, ask a question. I'm here for you, babe. Just let me know you're alive, huh? See you tomorrow. Ripper. And once again, thanks for being a client of TradersWay.com.